Hello, welcome. This is smarthelping.com, and we are doing an overview of the hotel acquisition and development financial model. Don't forget to subscribe, like the video. I also live stream every day, weekdays at 10 a.m. Eastern on YouTube. Okay, so for this template, I've never done I've done a lot of different real estate models, a lot of commercial real estate models. I've never done a hotel acquisition specifically. So this is what we have here, and I'll go through all the assumption tabs. We've got fully integrated income statement, financial balance sheet, cash flow statement. We've got discounted cash flow. We've got a bunch of visualizations. We have cash flow waterfall, sponsor and investor summaries, and all sorts of stuff. So let's start on the main global control tab here. This is where you can define all the assumptions for the company name, the launch year, exit month up to 10 years. It could end on any month. That'll stop all operations. And then you could choose to include terminal value or not here. If no, this is all zeros out and it just runs through to the end of the whatever your end month is. If yes, it will pay off any debt that exists at the time and uh, give you a net exit value based on a cap rate, which is based on trailing 12-month NOI of the exit month. You also got selling fees, net sales proceeds, um, and note on the debt you can do refi options. There's an option for interest only. We'll get into all that. Then we define when the rooms open up, when you start collecting revenue. This applies to all the rooms of the hotel. So there's definitely the idea here is you can plan for having a construction period, development period that lasts for some amount of time. During that time, you can have a construction loan that either accrues or applies interest, and that all goes through to the financial statements correctly. And then at the end of that construction period, it can flip over to a regular P&I loan, and then that P&I loan can then be switched over to a refi at some point in the future as well. If you want, you can switch the refi option to off. You can also switch all the debt to off right here by saying no on using development construction loan. You can also use, if it is just an acquisition or you're funding some of it with debt, you can hit yes here, and then you would go over to the debt schedule here, and you would have all the costs would be in the same month on the development acquisition tab, which is the second tab, and you would put, I've separated them out into sections here, so you've got acquisition costs, a bunch of stuff for that, as needed, development costs here, and then there's a bunch of other costs you can put in over time or singular, and this is only for acquisition, development, land costs. Then down here we've got fees for the GP that are paid by the LP or paid by the structure itself. So these would increase the total deal cost, and depending on how the equity contributions are defined, that applies accordingly, and we'll get into that more. But again, if you just had a single month acquisition, you'd put all that in here, and there's plenty of slots to account for this. I kind of went overboard, but it's better to have more slots than less. So you've got that here. And then again, let's say if everything were in the same month, you can go over to your debt schedule and you just put 1-1 here and 0 interest rate. And in that case, this would just roll right over to your P&I loan. If you're doing debt but you don't have any interest only loan, it's just a regular loan. So you can model that easily by adjusting some of these assumptions, and you can define the percentage of all those costs from the other development tab that are going to be financed, and also the max months to draw from with this debt, because potentially you could run into a situation where the hotel has a burn rate for a little bit and you don't want to those funds to be put into a loan, even though they're negative cash flows. You just want it to come out of equity. That's fine. This number right here will define when you stop drawing from any negative cash flows. So very flexible logic here. Let's see. You can define the percentage financed. So if it was 100%, it's taking all of the money. If it's 50, it takes 50, or whatever the case. Let me undo this so it's back to how it was. Okay, so really dynamic assumptions here. We go on to depreciation. So here just is defining a useful life for each of these sections. And all this is going to be a function of depreciation. Um, and then you can see the exit value, net sales proceeds pops in here. And that goes against the depreciation that's been accumulated over the whole time to get your actual gain or loss on the sale at exit if it is included. So that all flows to the income statement. Revenue assumptions. Here's the meat and potatoes of the whole model. So I did up to 20 room types. I felt like that was enough to cover most hotels. So 20 room types, and then each type you can define the count of rooms, the base daily rate. You can define for seasonality. You might have variances from this base rate. For example, in more busy months, you might charge more. So you put anything over 100% increases the base rate, and then in slower months you might charge less. I put a little schedule here to see what the base rate is based on those percentages for year one. Now, because it can change, if you put this changes the base daily rental rate or booking rate for the hotel over time based on how long it's been live. So that base rate will go up, and then that base rate, whatever it is, will apply to these percentages accordingly. And then we have occupancy as a separate schedule here, and this is again for seasonality. You can define your average occupancy in each of the 12 months, as well as an improvement in that over time if it's applicable. And this just percentage improvement drives each column. And then this is a maximum occupancy, and whatever this is, the model will stop at that whenever it hits that rate for each of these. Then we have also ancillary income for any other items that you're collecting revenue from per month. And this will apply to this room rate increase, revenue increase rate. Staffing. So this is a little bit, a hotel's more hospitality. It's a little bit more intense than, say, a multifamily building. So for this staff, you need more options, more robust options. So we've got, up to 38 staff types, and each type can be individual, or you can do bulk and define their count, the monthly salary, payroll taxes, benefits, and the start month of each. And then more staffing positions here. This works the same. I just have it in a separate section. This was supposed to be for more bulk items, and this is supposed to be for individual, but it turned into something where they're all the same functionality, so it's just as robust as possible. And then you can see here's the yearly monthly salaries, and that will be based on this percentage increase. The payroll tax and benefits are going to calculate on this benefits tab over here for all those staffing items. Okay, and then other costs, these are your fixed costs to run the place. So utilities, maintenance, insurance, legal fees, anything that's just a fixed monthly cost. You can define here the monthly amount, the start month, and then annual increase in that expense, and that will apply over the 10 years accordingly. Cap table. So there's a couple different ways this can be structured. If it is a joint venture or where you're raising money from investors, you can put any money raised from investors here, any money raised from owner-operators here, and then the relative percentage of ownership. Now remember, I've done two things. I've done this version, which is a very simple version where you just have cash in, and then you define you have cash in and you just define the percentage of returns they get manually here. And I've done a couple different stock options, but here we're just doing common stock in this case. You just need to make sure that they all always add up to 100%, however you structure it. So it's a very simple way, and then you can see the contributions based on those rates, how much they've contributed over time, and how much is returned over time by month. And then the resulting internal rate of return has been annualized here over that whole period. And then I did an annual summary down here as well for each with IRR. So that's the simple version. There's also a waterfall with IRR hurdles, and you can define the contribution rates on that as well as the hurdle rates, the cash split at each hurdle, and that's a little bit of a different setup. It's more advanced, but it doesn't break anything down into individual investors. It's just groups of LP and GP. But it just has a lot more advanced logic for cash flow split, which we'll get into. But this version is connected to, they're both connected to everything. This is just a simple, more simple way. Then we have debt schedule. I kind of went over this already. You can define all these assumptions for when this development loan starts. You need to make sure this month is represents the first month you have a draw. So that will match whatever month you start having costs on this development acquisition. If you are going to fund some of it with debt, the period that it's going to last for before it goes into a P&I loan, interest rate, and then if you're going to accrue it or not. If no, you'll have payments. If yes, it'll be accrued. And then the acquisition percentage of those costs that are going to be financed, and then the max months to draw from it, the negative cash flow that happens. Traditional P&I, you've got the term, interest rate, amortization period, any prepaid penalty fees, and then this goes for a period, and then you can define if there's a refi or not. You can see we have yes here. If we hit no, this original loan just runs to the end, and this doesn't populate. If we hit yes here, this flows here. You can define what month the refi is actually happening, the cap rate to define the value, then the LTV basis, interest rate, amortization on this final loan, any prepay fees, and then that populates accordingly. And then that will, the repayment here will happen based on the end month defined right here. So if we were to put, say, November, you can see, now it's in November where it's repaid. We'll put it back to December 30, 2032. See, now it's December 2032. So that's all dynamic. Income statement, pretty straightforward. We've got our booking revenues, other ancillary income, all the OPEX, any fees for the GP that the GP is receiving. These count as costs to the deal. Renovation fees, acquisition fees, management fees. Here's general ongoing management fee. Net operating income, interest, depreciation, net gain or loss from the sale, which is we talked about how that's calculated here, and then any taxes applicable, taxable income, and net income. Income statement annual, same deal, but on an annual basis. Balance sheet, just showing the cumulative effects of all the accounts, and obviously assets are going to equal liabilities plus owner's equity. We've got cash, we've got the building, which is going to be a function of all the development costs, any purchase price, all the costs to buy the place or build and develop it. Debt, just dynamic, and then LP and GP equity based on the equity needed and how much is contributed from each. Retained earnings, total equity, liabilities, owner's equity, and then total assets. Balance sheet annual, same deal, but on an annual basis. Cash flow statement, this is going to show your activities from operations, investing, and financing. You can see we basically are solving for zero here at the beginning because we're making sure the cash balance doesn't go below zero, so we're funding just enough money to keep it above zero based on all the different activities. Distributions tab, this is just a discounted cash flow analysis. We've got cash in this row, cash out in this row, each monthly period. And then we just simply say any cash out is split based on that contribution rate defined on the cap table. And then the cash in is split based on the total fully diluted ownership of each here. And then we just run a discount rate on that to get the net present value of the investor leg, the owner leg, and the project as a total. Also have some visuals on an annual basis here. Again, this is a more simplified version than the cash flow waterfall, which we'll get into here in a second. Visualizations, we can see our annual revenue by revenue type, so bookings versus ancillary income, annual EBITDA, annual revenue versus expenses, cash flow versus cumulative cash, balance sheet cash position, assets, liabilities, and owner's equity over time, net operating income versus debt service, and the ratio therein. This is very important for the banks to see. They want to see how you're going to service the debt with your net operating income. Annual revenue by room type, just an analysis of all the different rooms over time based on their occupancy rates and sizes and booking rates and all that. It'll show the total revenue of the bar is like all the revenue of the whole hotel, and then each individual one is how much each room type is contributing. Average occupancy, you can see we're stabilized at 90%, working up to that. And that can be defined in the assumptions. And then total occupied nights booked. So here, this is saying per year, how many nights are you booking across the whole hotel, across all rooms? So just over 60,000 nights here, based on having, what do we have, about 200 rooms. So you think 200 times 365 days, the max would be 73,000 roughly. We're at, 65-ish here. And that's slowly going up. But you can see by room type as well as the total of all the rooms, how many nights are being paid for over the course of a year. Executive summary gives you a high-level look: revenue, gross profit, staffing costs, selling general administrative costs, and management fees in here. Total expenses, net operating income, debt service coverage, then these other cash flow items. And note the, here in this case, the general acquisition and renovation fees are separate here. The only thing that's in here is the ongoing management fee. Then cash flow, cumulative cash, some charts here for revenue and net operating income, IRR, equity multiple, ROI of the whole project, and then for an investor and owner leg. Then the monthly detail, this is where you can see all the assumptions come together. So you've got, this kind of follows the assumption tabs. You got development acquisition costs, the base room rates here, seasonality adjusted room rates based on the month, occupied days, revenue per room type based on all the rooms of each type, ancillary income, total revenue. Then we've got our staffing costs here, staff, payroll taxes, overheads, expenses, net operating income, CapEx, cash flow before financing. Here's our waterfall for what's financed. So here's the interest only loan happening. Then we go into the regular initial loan and then the activities of the refinanced loan. Debt service, cash flow after debt service coverage ratio here, taxes, exit proceeds, final cash flow, and then we've got our acquisition, renovation, and other fees here. These are just for on the initial cost, and then the ongoing fees are here. Once there's revenue, and these ongoing fees are based on a percentage of gross bookings. Now here's where we have the waterfall. So this is a little bit different style for a joint venture, and you've got equity contribution here. So it could be 100-0 or 95-5 or whatever it is for the LP versus GP. And then here we can say, well, up until a certain hurdle rate, the LP will get this much of the cash flow. GP gets this much, and then as the LP increases their IRR based on the cash flows, you can lower their return. Essentially, this is the promo for the GP. We've got 3 hurdles here that show the differences in the total. Now remember, we also have the other management and acquisition fees and management fee income for the GP, so that flows as income to them. So that offsets a little bit of the cash requirements that they might have in this structure. And then as you go over, you can see once those fees stop and you've got operations, now you've got an ongoing management fee. And remember that cash flow is already coming out of here, but it's just coming out of the deal and going back to the GP. So it's like an expense for the deal, but revenue for the GP. Then you've got discounted cash flow analysis for the sponsor and investor in this style of a joint venture. And then on the annual, you can see just a summary for the sponsor GP here, and the investor by year. And for the sponsor, we broke it up into their contributions, distributions from the deal, their fee income from renovation, acquisition, all those initial costs, and then ongoing management fee income, and then total cash flow for the sponsor here, and then cumulative. Now for the LP, they just have what they've contributed and what they're getting back on the deal, and checking that to make sure it matches all the other items, and then just a summary here. Well, and that's all the model. So this is a very comprehensive template for planning out the acquisition, development, or construction and operations of a hotel, single hotel. And we've got everything you could ask for here out of the box. The template, you can purchase it in the description box below. I'll put it across all the vendor sites as well. The cost is going to be $45 one-time fee. I feel like that's a very good price for all the value you're getting here. And that's all I got for you. I'll see you on the next one.